Did you know that the average American has less than $100,000 in their retirement? Well, by the end of this video, you'll have a clear roadmap to beat that average and build real wealth for your future. I have spent 10 plus years understanding money and the ways to maximize your future gains. And through all of that, I realized that you don't need to be an accountant or have a finance degree or be rich to figure this stuff out. So what are we going over today in this video? Well, we're going to understand the different types of retirement accounts. We're going to understand the order of funding these accounts. We're going to understand the way you can save more, like are you saving enough? And finally, I'm going to give you actionable steps that you can take today to maximize your contributions to these accounts. So if you're ready to take control of your financial future, like and subscribe below and let's get started. So most people start with a 401k, which is the foundational retirement account. Usually it's offered by an employer and they provide some type of match. And the reason that this account type is really important is that they are pre-tax dollars, which means that you don't pay taxes on them now and you get to deduct them from your tax. Later down the line, when you retire, you're going to be paying taxes on the distributions from this account. So the power in this account lies in the fact that you can get free money because your employer matches up to a certain percentage and you have to go to your employer and ask HR what that percentage is. For example, my employer gives me 50% of what I contribute up to 16% of my paycheck. So, which is really nice. That's basically equivalent to about 8% match for my employer. So the contribution limits for this account for a 401k for 2025 is $23,500. But if you're over the age of 50, that contribution limit increases to $31,000. You can add about another $7,500 to that contribution. As it's called a catch-up contribution. So all in all, this is a very powerful account, and I would suggest getting up to the match for sure, because that's just basically free money that you don't want to leave on the table. The next account type that I want to talk about is called a Roth IRA. And these are really cool because they are tax-free growth. So post-tax dollars. So you have paid let's say you paid your taxes through payroll and you get your paycheck after tax, and then you can contribute to your Roth IRA if you have your personal Roth IRA. And sometimes you can even do a employer-based Roth IRA. Depends on your employer. But the cool thing about this is you've already paid taxes. So the money that you put in here will be growing tax-free for however long you have until retirement. So that could be decades of tax-free growth. Let's say you have $10,000 in your Roth IRA at the current moment. You contribute so that the growth goes to $1 million in 40 years. That $1 million you can take out tax-free at that time, which is amazing benefit. So the contribution limits for a personal Roth IRA is $7,000 for the year for 2025. And if you're over 50, it's $8,000. The last account type that I want to talk about, and this one is basically a game changer, is called a HSA. And you probably know what a HSA is, and if you don't, it stands for Health Savings Account. And you might be asking, why am I talking about a health savings account in a retirement video? The reason is the health savings account is actually an off-label retirement account, and few people relatively know about this. This is a triple tax deferred account. Basically what that means is you can put in your money and be pre-tax, which means you get to deduct it from your taxes next year. It will grow tax-free if you can use it for qualified medical expenses before a certain age. After 65, it basically turns into a Roth IRA where you can take it out for any purpose, not just medical purposes. So the requirement for getting a HSA is basically you have to be enrolled in a HDHP, which is a high deductible health plan. So otherwise you can't do a HSA. And a high deductible health plan is basically one where the deductibles are higher than a normal health plans. So once you meet those deductibles, then the plan starts to kick in and pay the rest using insurance. The contribution limits for a HSA in 2025 are $4,300 for individuals, $8,550 for families, and then those 55 and older can do a catch-up contribution of $1,000, which means that you could technically just fund that up to that limit, the max contribution, and keep about $4,000 or whatever the deductible is in cash and invest the rest. And the reason you might want to do that is just in case you have some type of medical expense that requires you to use the full deductible, maybe $4,000, you have that cash on hand and you can take it tax-free at any time from that account. But the rest of it, you could be investing the rest of the $4,000, $5,000 in there every year. You can be investing into high growth stocks, high CAGR stocks, compounding machines that you could be making tens of thousands, hundreds of thousands, millions of dollars in the next few decades, all tax-free. I did want to mention one other thing about the HSA, which is really amazing, is you can defer all your medical expenses. So as long as you have a receipt. So if you have, let's say I go to the doctor and I need to have dentures put in or something like that, and they cost like $4,000. That $4,000 receipt can be deferred. You don't have to, you can pay that out of pocket now when you have to have that expense. And then you can go 10 years down the line and pull that receipt for $4,000 out and basically take out $4,000 tax-free even before 65. You can just take out that money, $4,000 worth, tax-free, no penalties. And that is an amazing benefit to this. I think this is the most powerful retirement account that you could possibly get. And if you are able to do it, and if it works for your financial situation and medical situation, I would definitely recommend doing a HSA. So the first thing you need to do is match your 401k. That is free money. That is the end all be all. You have to match your employer's contribution up to your employer's contribution at your job. You don't want to leave that money off the table. So that's number one. Next depends on whether you have credit card debt or not. So if you have credit card debt, high interest rate credit card debt, you need to pay that down next. Card debt, you have to go to HSA. Because if you qualify for the HSA and you have a HDHP, you need to get that HSA money. Because that is almost better than anything else besides the employer match. And after you have contributed the max to the HSA, you can do your Roth IRA because that's the next best account after a HSA. So how much do you need? How much do you need to live in retirement? And this question is a very important question, but the only real way to know for all different types of people is how much you're going to need per year. So everybody's different and everybody will have a different amount of expenses. So let's say for me, I need $50,000 a year in retirement, 20 years from now or 30 years now, whenever I'm going to retire. So if it is $50,000, then how much do I need to live off of in retirement? And the answer comes from a common rule used in the industry, and that's called the 4% rule. And the 4% rule basically states that take my yearly expenses, or how much I need yearly, let's say $50,000 to live, and then divide that by 4%. to get the actual number that I need to have in my retirements or other accounts that I'm going to use for living. So let's say 50,000 divided by 4%, and you get $1.25 million. And that's my number. That's how much I'm taking out of my, principal. Next, make sure you invest your funds. I can't tell you how many times I've heard that people just, automate, which is great. They automate their savings into retirement, but they forget to invest the money. So the cash is just sitting there and it's not doing any compounding unless it's invested into, high compounding ETFs or individual stocks or just anything else that can compound your money and get you those millions in the future. So you don't even have to pick individual stocks. You can pick, if you don't know anything about stocks, well, that's why this channel exists, to teach you about those things. But if you don't want to even have the hassle or worry about that, you can just track an index. Use SPY, which tracks the S&P 500. The last actionable step that I have for you today is increase your contributions over time. As your income grows, your retirement contribution should naturally grow. So this is usually taken care of by your employer when you set up a percentage contribution. But if you're doing manual, a fixed number contribution every month, make sure you adjust that to go with your raise or your promotion so that you're contributing the full amount up to the contribution limit, and to make sure that you get that match from your employer. I hope this helps change people's contributions and helps them maximize how much they'll have in retirement in the future. And if you like this content, please like and subscribe below and leave a comment on how much do you think you will need in retirement to have the life that you want and desire. So thank you guys for watching, and I'll catch you guys in the next one.